All right, let's get it cracking for sure. Hope everybody's feeling great. This is week number 2, Traders Blueprint. And this week we are going to go over the entire uh idea of what strategy is in the market. Okay. So strategy is a lot more than what you think. It's not just getting the trade and getting out. And so there's reasons that you're going to need to understand strategy. And this is the reasons every trader needs a strategy. Okay. Trading without a strategy is like driving blindfolded. You might get lucky once, but eventually you're going to crash. And so here's why having a strategy is non-negotiable if you want to last in this game. Okay. So the first thing that strategy does is consistency wins every time. Without a strategy, every trade is a guess. A strategy gives you a repeatable process so you're not just gambling with your money. So think of Steph Curry. He doesn't change his shot every game. It's the same form, same process, same results. It's the reason why he's considered one of the greatest shooters. You got to understand the process of the repetition that it takes within your strategy. And so that's exactly how trading works too. Professional traders develop muscle memory around their setups. They recognize patterns instantly because they've trained their eyes to see the same signals over and over again. Random trading leads to random results. Strategic trading leads to predictable outcomes you can build wealth on. Okay. A strategy also helps protect your account with your risk management. Okay. So having your strategy, you're going to have entry rules, which you're going to know exactly when to get in based on your tested criteria, your strategy, your exit strategy, predefined profit targets and stop losses to protect your capital, right? And position sizing, risking only what you can afford to lose on each trade. And we're going to show you how to set all of that stuff up. Your strategy tells you where to enter, where to exit, how much you're willing to risk, and that means one bad trade cannot wipe you out. So the math is, for example, if you're risking $100 with the potential to make 300, if you lose twice and win once, you're still ahead $100. So that risk reward is going to be very important. They're going to show you how that works. This is how professionals think about risk reward ratios. All right. Another benefit of a strategy, it helps to keep your emotions in check. Fear and greed will wreck you if you let them run the show. A solid plan takes the pressure off because you already know what you would do before the trade even starts. So if the price dips below your entry, if your stop is at say 45.95, you don't panic. You just follow your plan. So you don't having a strategy helps prevent you from having emotional decisions, no second guessing, and no staying in losing trades hoping that they'll turn around. And that's a big issue with a lot of people. Like, oh, it's gonna turn around, and that's why a lot of people lose. We're gonna teach you all of that, keeping your emotions in check. Your strategy becomes your emotional circuit breaker. It prevents you from making desperate moves when the market gets volatile. All right. Your strategy is going to stop you from overtrading. All right. So a random trader will take 20 trades, burn out, lose their money, chasing every price movement. A strategic trader takes one clean breakout setup and bags $500, $1,000 with one trade, right? And that's why beginners blow accounts by taking too many random trades. A strategy filters the noise and helps keeps you focused on only the best setups. It's quality over quantity in this game of trading, right? In professional trading, it's about the quality of your trades. All right. And also, when you have a good strategy, it shows you what works and what doesn't. You're able to track your performance. When you follow a strategy, you can track your results and see patterns. You will discover which setups win for you and which ones to avoid. And maybe your moving average system crushes trending markets but fails in sideways choppy markets. And that's gold knowledge that separates profitable traders from the rest. Data driven decisions beat gut feelings every single time, right? And so if you got a strategy, you got it in place, you can actually see why you're losing. That's the beauty of having strategies in place. And it builds your confidence to pull the trigger. Having a strategy in place, pattern recognition, it spot a flag pattern you study for 100 times, you're able to see what's going on. Confident execution, you're able to take the trade with conviction, no hesitation, no second guessing, no handshaking, and all of that stuff, right? And then no chasing. You're going to stick to your entry rules. You don't chase prices that got away, right? And so your hesitation kills profits. When you trust your strategy, you don't freeze up, you don't second guess yourself. You execute with precision of a surgeon because you've done the homework, right? And this sets you up for long-term growth. I want y'all to understand that trading is a marathon and not a sprint. A good strategy turns small, steady wins into big results over time. And so the power of compounding works in your favor when you're consistent. On a funded Top Step account, earning 1 to 2% per week as of fast. That's how you stack $10,000 by Christmas. All right, y'all. The professional traders think in terms of monthly and yearly returns, not individual trade outcomes. So we gonna show you how to look every week, weekly, monthly. You got to be able, this is a business. This is not just running in here. So you're going to have to go back and look at your own paperwork, look at your own trades, see what's going on. This is a business. You build wealth through discipline, not through lucky streaks that always end badly. And another great thing about having a strategy, it saves time and it holds you accountable. Okay. So the efficiency, so it's no more staring at the charts all day hoping something happens. A strategy tells you exactly what you're looking for, so you trade less and live more. You're not here to be sitting here all day from 8 o'clock in the morning to 6 o'clock in the evening when the market closed. This is not that type of job. We end to be in and out like a robbery, as I say, and the strategy helps you to be able to pull that off. And also the accountability. I know that's a word that's been going around the internet for a long time, and they say a whole bunch of things about accountability. But in this stock market, when trading, when you have a strategy and when you have a plan, you can't blame the market for your losses. If you break your own rules, that's on you. And that's how you learn. So you got to understand if one trader spends 10 hours glued to the screens, they're going to leave drained, tired, if another waits for their setup, trades once and walks away with profit. If your rule says only trade when the RSI and the moving averages align and you ignore it, the loss becomes your lesson. So it's about understanding your strategy, understanding when to get out. And this is a process that's going to take time as you build your strategy, right? And that is what separates the pros from the amateurs. All right. Retail traders, and amateur traders, they have a gambling mindset. They may got one lucky win and then they give it all back chasing that next thing. A professional mindset, a pro trader shows consistent profits month after month and keep scaling up their accounts. Remember, your strategy is your shield and your weapon at the same time. It protects your money, it sharpens your mindset, and it gives you a real shot at long-term trading success. So anybody can get lucky once, and professionals make money over and over because they stick to their strategies. All right. So we're going to get into everything that encompasses what is within your strategy. Last week we went over the candlesticks, and I made sure I did that in the first week so you could know what you're going to be looking at here. And now that you know what you're going to be looking at, how do you put that together with everything else? Okay. And so that everything else is, give me 1 second here, going to be a part of this trading strategy checklist. Okay. I'm going to put these PDFs into the stand store for y'all to download later. They're not in there right now, but I'm going to make sure I get them in there probably by the end of the day. Y'all also going to get a recording of this week two workshop. Okay. But we're going to go through everything that your trading strategy is going to need. It's not just about getting in and out. We're going to take our time. We're going to get through this, right? So y'all can have a full comprehension of what your strategy actually entails. All right. And so a real trading strategy is more than just entries and exits. It's a comprehensive framework that covers preparation, execution, and review. And so this checklist will help you build consistency and discipline in your trading approach, transforming you from an impulsive gambler mentality into a methodical professional trader. All right. And so this you use this systematic guide to help develop a complete trading system that addresses every aspect of the trading process. This is from pre-market preparation to the post-trade analysis. And you need to remember, successful trading isn't about predicting the future. It's about having a proven process that you execute with unwavering discipline. All right. And so the first thing when it comes to one of the first things when it comes to your strategy is understanding the market and your time frame selection. All right. So you have to define your trading universe. Everybody's trading time schedule or whatever how they're going to use will be different depending on what you trade. Right now, we're day traders, right? So it's going to be different than somebody that's swing trading or somebody that's buying and holding. So you understand what you're doing. So the foundation of any successful trading strategy begins with clearly defining what you trade and when you trade it. So this is not about limiting yourself. It's about becoming an expert in your chosen domain. All right. So your market selection, you're going to choose specific instruments based on liquidity, volatility, and your available capital. And that's why we choose the ES futures because they offer tight spreads, high liquidity, you know. Forex provides 24 hours access, but it requires currency pair expertise, you know. So futures is the best way for individual to actually get into the market with um without being in over your head. All right. And individual stocks allow for fundamental analysis integration, but it demands more research and time. And that's why I deal with the ES or the S&P 500. It's the same thing. But when you're trying to figure out individual stocks and all of that other stuff, a lot of things can become more complicated. You find your lane, right? And you master that. Kind of like Steph Curry. He the best three-point shooter in the history of the game, they say, right? That's from him mastering what he needed to master, right? And the time that he took in on one specific thing, you know, and that's part of the idea of it. Once you get the ES futures market mastered and you understand the basics of how to trade, it becomes easier for you to take this information and apply it to options or apply it to forex or apply it to individual stocks. But this is the lane that a beginner should be in because it's just the best lane. Just trust me. And your time frame alignment. Your time frame must match your lifestyle and personality, right? And so some people do scalping. I don't really like scalping. It causes you to overtrade. We go get into that. Intraday trading, 15 to 60-minute trading balances opportunity with manageability. And then, of course, swing trading, which we're not going to be doing that here, but y'all are going to learn something about it. And swing trading, if you got your own money, it's good if you got a full-time job, but it does require you to risk overnight. All right. And so you choosing your market. We trading the ES, we trading the futures. You know, we choosing our time frames, right? We trading off the 5 minute candles, the 5 minute time frame and test your compatibility and ensure your chosen combination fits your risk tolerance and lifestyle. All right. And so basically, of course, we inviting everybody to the signals group in the morning once you guys get your account set up, and then you'll be able to trade with us in the morning. And that's gonna give you leverage. Even if you don't understand the market, you will have enough information to be able to trade with us. But at the same time, everybody's not available at that time in the morning to trade. And so that's part of your own strategy in which you're going to have to learn on your own how to trade in specific other time frames that may be more suitable for you and your own personal lifestyle. All right. So trading at 9:30 may not be good for you, but you may have a clear day after 12 noon. And so you may be able to trade the end of the day of the market, or you may work all day and you may be able to trade the 6 p.m., or you may be able to trade the London session at 3 in the morning. The futures market is open 23 hours a day. There is always a move there, but it's about learning how to catch the move and implementing that into your strategy so that you could be able to be consistent in catching those specific moves every single day. All right. And that goes leads us into the trading session and the schedule. All right. Define your trading hours. Establish specific time windows when you are actively trade. The most successful traders work during high probability periods rather than watching charts all day. And so for the US markets, that's 9:30 to 11:30 in the morning. That's the maximum volatility and volume. That's why we are in the signals group. And if you've been in the signals group with us, you will see come about 11:30. If we ain't got a trade, all right, y'all. See y'all tomorrow. Today ain't the day. You got to be able to have enough confidence in yourself and enough knowledge to be able to see that the market is not doing what you want it to do. It's not giving you the setup that you want, and you're able to walk away. And a lot of times, you're able to come back later on in the day after lunch and catch the power hour before it closes and probably get a move there. All right. And so your trading session and your schedule will also help you avoid chart addiction. All right. I'm telling you, those candlesticks can, it's like watching paint dry. But at the same time, it can be, you will get locked in. And next thing you know, you don't even know you're sitting there. You could be sitting there all day. And that's not a good thing. Unless you're practicing back testing or something, you shouldn't necessarily be actively in the market all day. And that's chart addiction. And staring at charts all day, it leads to over trading,
Huh?
fatigue, and poor
Oh,
decision
I'm gonna
making.
do it pick order. Not yet.
And
Ah,
make sure
okay.
you
Okay.
mute yourself, whoever that is. I don't want to have to go in and mute you. So set specific trading windows and stick to them. All right. And you use, if you want to be in the market, that's why I say use that up time for other productive activities,
I'm
market
gonna place some
research,
God order.
strategy back testing, or skill development. Okay. So you need to predetermine your times you're going to trade, just when your session going to start, when it's going to
Ooh.
end, when you're going to take breaks in between sessions. All right. And have chart free zones during your off hours. This is not designed for you to be sitting up here and looking at this all day. You know, you could do some trading psychology, open up one of the books, listening to an audio
Yeah, I'm gonna
book or
make one.
something like that.
Are you
It's
good?
a
No
lot
way. Yeah,
more.
no way. That was good. Okay.
Oh, I might have to use somebody. Hold on. There it is. I see somebody with the hand raised. Go ahead with your question.
Hey Theo, are we gonna get added to that group uh anytime soon if you have not taken this class, or that's just for people that already
The morning signals group, we're gonna offer that to you once once you're set up with your account and stuff. Okay.
got it?
So yep, so that's gonna be in the mornings, but I want to make sure that before I just toss you eyes in there, give you your account and say go in, because in the morning signals group, we can't be asking any questions. That's the time to focus, that's the time to get the money. And so I want to make sure that you're set up to be successful and not, you know, and be able to actually participate in the call in the right way when it's time for you to get in there. And so that's why going step by step. And so probably in another 2 weeks, y'all will be primed enough, because come next week and the next couple weeks, we're gonna start setting up everybody's accounts um on the top step, so that you will be able to have the opportunity to get into that morning signals group. Okay. but it's all about building you up so that when you get in there, you're not like a deer in the headlights, because when the call come out and say buy the ES or buy this or sell this, you need to be able to act in a certain precision, you know. You can't be in there asking questions, what are we doing? You need to know what you're doing so that you can make the money off of the call. Other than that, it's no purpose in you being there. But with that being said, we get back in here. Okay. Um, what you got to understand is professional traders understand that trading is a marathon, not a sprint. And by limiting your trading hours, you maintain focus during the high probability periods while you're avoiding the mental exhaustion that comes from constant market monitoring. All right. You have to be able to give your brain a rest. You have to be able to let your mind rest, before you get in this market. Fatigue will have you making bad trades. It'll have you over trading. It'll have you revenge trading. And so it's good that's why I tell y'all guys, I make sure I have me 2 cups of tea before I even sit down to trade. This part of my strategy, it's part of my routine, it's part of making sure that I'm awake. Okay. And so another part of your strategy is your account setup and your risk parameters. And so your risk management foundation, all right? And I got these in percentages here because as you become a professional trader, you can start thinking in different terms. So you can think in dollar amounts, or you can also think in percentages. A lot of the times it's easier to think in percentages or R&R, risk reward, instead of a dollar amount. It's a psychological thing sometimes when you put dollars behind everything, when you put win and loss behind everything. Sometimes subconsciously you may take that in the wrong energy. All right. So if you change up the terminology a little bit or change how you're looking at it a little bit, then it can become a lot of times easier for you to digest mentally because you're not looking at it. If you say you're trading 2% per trade, that sounds a lot easier to digest than saying I'm risking $500 sometimes. So sometimes it's the idea of how it's presented to you. So don't be afraid by the percentages. You know what I'm saying? I just understand that your account setup and risk parameters from the form the bedrock of sustainable trading. All right. And so these rules protect you from catastrophic losses and ensure longevity in the markets. So a per trade risk, never risk more than 1 to 2% of your account on a single trade. This isn't conservative, it's mathematical survival. With a 2% risk per trade, you can withstand 20 consecutive losses and still have 67% of your account intact. Like, that's why you build it up a certain way. If you say, oh, I think it's doing this, and you put $1,000 stop loss on a $2,500 drawdown, that the percentage doesn't make sense. And if you lose, then you will be out way faster than you need to be, which leads me to your daily loss limits. You set a maximum daily loss limit, typically 3 to 6% of the value of that account, and you stick to it religiously because revenge trading after hitting this limit destroys more accounts than any single bad trade ever. And you're gonna understand what I mean when we start getting into the stop losses. You leave your stop loss where it's at. The only thing you're doing is making it smaller, not bigger. If you got to make a bigger stop loss, then you're probably out of position. And if you're moving your stop loss big to try to stay in the position that you're out of position on, you're more than likely going to have a bigger loss than you imagine. Your feelings is going to be hurt. You may start revenge trading again. And then that's how people blow their account. These rules for these strategies are in place. Okay. All right. And so you got the position size and formula right here at the bottom. Position size is equal to your account value times your risk percentage divided by the entry price minus your stop loss price. All of that is to be exactly precise as a professional. But understanding the dollar amount is usually around $200 to $250 for a $50,000 account as a general stop loss. But that is the position size and formula. We'll get into that further in the future. Just make sure that y'all got it. And as I said, I'm going to add these PDFs to the store too so that y'all can review them later. All right. But the next thing we have here, as far as your strategy, you're going to need your entry criteria. Okay. We're looking for objective and repeatable conditions. Your entry criteria must be so clear and specific that another trader could come and execute your system identically. Vague rules like when it looks good or strong momentum lead to inconsistent results and emotional decision making. All right. So the first thing we're looking for the technical conditions, the specific chart patterns, the specific indicator readings, or specific price action setups. So example of this is like something that you might hear. You got a bullish engulfing candle at a previous level of support, and the RSI is below. It gives us a good idea that the market is going to go up. Right? That's just kind of how you will read a specific entry point into the market. That's the language of it. All right. Um, volume confirmation, right? Volume requirements that validate your setup. All right. So an example of that is say the current volume tune is 1.5 times the 20 period average, or the volume spike on a breakout candle, right? And we watch the volume a lot in the mornings. If it's not enough volume on the move, we sit on our hands because we're not just going to jump in there. This is a follow the leader kind of thing. You're going to figure that out as you learn to trade. You want to go with the flow, not against it. So it doesn't matter if a candle comes out real super big. That doesn't necessarily mean that's the direction it's going, because the volume indicates how many people are being involved in the trade. And so if the price goes up, but it's not a lot of people involved in that trade, it may be a fake out. And so that we're going to teach you how to be able to identify those things, to help strengthen your strategy. All right. Big thing number three is market structure. We're going to go over market structure today. All right. Later on in this class. The market structure is a broader market context requirements. So an example, the trade only in the direction of the daily trend, or no trades within 10 points of a major support and resistance. And so if you in a signals group in the morning, you will hear us sometimes say, we're not about to play around in this triangle, or we're going to wait until X, Y, and Z, because we're looking at the market structure. And if the market structure doesn't dictate a move, we don't take it. Or if the market structure shows that it's maybe a change of direction in the move, we're going to wait on that. We're not just jumping in. We're letting the market structure show us. All right. And number four, which is this is a big thing, multiple confirming signals that increase the profitability, right? Probability, excuse me. All right. So for an example of that, you may hear us say something like, oh, the moving average is supporting the Fibonacci retracement, and we got bullish divergence in the RSI. All of this sound like a foreign language to you, but the more you see it, the more you will be able to identify it and speak on it. Okay. And as you're learning your strategy and you're able to get your entry criteria, you should be documenting every entry condition in writing. All right. If you can't explain your entry criteria to someone else in precise terms, your system isn't ready for live trading. You got to be able to back test your system extensively before risking real capital. Okay. And that's the point. We done been through the trenches, so we understand how this market moves. So we able to give you the correct call in the morning and allow you to be able to build your account through that signals group. Okay. But with that being said, regardless of when you get in, you need to be able to understand why you got in. And if you don't understand why you got in, then you probably revenge traded, or you probably over trading. You got to check your emotions. Your entry, if you lose a trade, it shouldn't be because you didn't follow your strategy. It should be because the strategy did not work that day. Sometimes it doesn't. That's all you're doing is selling your strategy to the market. If the market buys it that day, good. If not, you take the loss and you keep it moving. And but when you go back to review your trade, you should be able to say, okay, X, Y, and Z happened, and that's why I got in. If you can't say X, Y, and Z happened and that's why I got in, you need to rethink your strategy and start understanding that maybe you need to be patient. Maybe you need to wait on things, wait on your particular setups. Okay. Or just like I say, you might just be out your mind, just sitting up there candle watching. If you're candle watching, you will make 1,000 trades in a day and don't know why. It's all about the setups, market structure, your technical conditions, conformance with the volume, and your other confluencing factors. All right. And the confluencing factors, RSI, EMAs, your volume, all of these things come together to give you a nice little package of reasons why you should take the trade. It increases the probability that the trade is likely going to go in your favor. There's nothing guaranteed in the market, but you just flipping the odds in your favor. That's what this strategy does. Okay. Of course, if you got an entry criteria, you also need an exit criteria, right? And this is for taking profit. There's no point of getting in there and if you don't know how to get out. And so your strategic profit management, how you exit winning trades often determines your overall profitability more than your entry technique. So you need to develop a systematic profit taking rules that remove emotion from the decision. As I was telling y'all, that's the set it and forget it. A part of that is having fixed targets. You set a specific profit levels based on your risk multiples. If you're risking 2 to 1, 3 to 1. So example, your first target is at 2 to 1, and your second target is at 3 to 1. Once you get to your first target at the two risk return, you move your stop loss up, and then if it hits your third target, great. If not, you will at least get your 2 to 1 return. Right? This approach provides consistency and removes the temptation to get greedy. Okay. Trailing stop losses. All right, is this allows winners to run while protecting your profits. You start trailing after, say, a 1 to 1 return, then adjust every time the price moves favorably by maybe another half of risk return ratio. And this captures extended moves while limiting the give back. A lot of times you get in the trade and they get to turning around on you. You don't want to be up $650 and then it turns around on you. And next thing you look up, you're only up $150 because one long candle came down. So a lot of times you may want to trail your stop loss up to preserve the winnings that's already in your unrealized gains. Okay. Scaling out, taking partial profits at the predetermined levels. Um, I don't really like this part of it, you know what I'm saying? But you can do it depending on your trading strategy. But I would rather just let it run all day, turn around and get on. Okay. And so you can have your target. You take 50% at twice your risk. You can have a trailing stop loss, but remember your final exit. Close your remaining positions out once you hit your target. Make sure you don't have nothing else running and that can potentially take your profits away. Sometimes you may look up, you didn't click the button twice. So you won on one trade, but you may be in 2 trades and don't even know it. You got to make sure all your positions are closed out. Um, your exit strategy should be planned before you enter the trade. Write it down and stick to the plan regardless of how the trade works. And so if you're in the Morgan and Signals group, you will hear us sometimes. If we get in here, we should be able to take it to this other level of support or this level of resistance. You will hear us tell you, we can let this run maybe for about this or about that. If it comes to here, you need to get out. And so you have to be able to move fluidly with the market based on how it's moving. Um, your stop loss rules, okay? Your stop loss is your non-negotiable protection. You will have a stop loss, okay? Your stop loss orders are your insurance policy against catastrophic losses. They must be hard stops placed in the market. Never have a mental stop that you rely on your discipline in the heat of the moment. You cannot do that. Just put the stop loss on there and leave it alone. And all you should be doing is after you get into your trade, if you get into the point where you're making some money, You move your stop loss to break even. You should never be moving it the opposite way. Hard stops only. You place actual stop losses on orders in the market immediately after entry. And we're going to set up your account to where as soon as you get in, it's going to already be there for you. Right? Mental stops fail when emotions run high and hope overrides logic. You got to be logical here. You can't hope the market is going to turn around. The market's going to do whatever it wants to do. So we're not playing the hope game. We're not keeping hope alive. We are not doing that shit. Hope is dead. We're dealing with logic and systems here. All right. Structure-based placement of your stop loss. Your stop loss needs to be based on technical levels. You putting it above or below a swing high. You got found to some support and resistance at certain levels. Um, and if it's a bunch of clusters, the market plays on the emotions of different numbers. So if you like, I want to put my stop loss at say 6,400, and it's a bunch of traffic candles at 6,400, you cannot put your stop there, right? Even though that number is a good psychological number, you still can't do it. You got to find a better stop. And as I was saying, never move your stop against you. You may tighten your stop to lock in profit, but never widen them to avoid being stopped out. This single rule prevents most trading disasters. And trust me, it's been times when, as a beginner, you're like, all right, well, it ain't come all the way down. I'm gonna move it down below here. And then you start seeing it come down. I'm gonna move it down some more. When you get to moving your stop loss, you may not necessarily be paying attention to how much money you're losing on that trade. Next thing you know, you done turn what could have just been a small $200 loss, and now you done lost $600 because you trying to move it down, hoping it'll turn around. It don't work that way. You got to be comfortable with what you're losing and stick to it. That's what your stop loss is for, to help you, is to protect you. It is not put in place for you to start fucking with it. Excuse my language here. So your stop placement guidelines, if you're a swing trader, you're going to place your stops beyond a significant swing point, with a little bit of buffer in case they wick you out. Breakout trades, you're going to put your stop below the breakout level or the recent swing low. That's what we catch in the morning. We're catching breakout trades. Trend following, you're going to use your trailing stop loss based on the moving averages, how the market is moving. And your reversal plays, type stops just beyond the invalidation level. And I love those reversal plays, getting in on that wick and putting my stop just above the wick. That's beautiful to me. I'm gonna show y'all eventually how to be able to do that on the 1 minute chart. All right. Part of your strategy is your risk to reward ratio. As I was saying before, the mathematics of long-term success. Your risk to reward ratio is the foundation of profitable trading mathematics. It determines how many trades you need to win to be profitable overall, regardless of your win rate. All right. So if you only winning 33% of the time, that means one out of every three trades you're winning. That means you need to have at least a 2-to-1 risk to reward ratio to break even. Okay. If you're only winning 25% of the time, you're going to need a 3-to-1 risk to reward ratio to break even. Okay. And if you're winning 60% of the time for your trend following strategies, that's a good win rate. All right. If you're following the trend and you're winning 60% of the time, that's a good win rate. But besides that, you got to make sure that when you're winning enough to counterbalance the losses, because every trade is not going to be a winning trade. So when you do win, if it's $1,000 day, you better get the whole $1,000, because you may lose the next 2 days, lose 250 and another 250, but you will still be up 500 if you got the whole thing out of your great day. So having a great day helps to mitigate the losses that you're going to eventually have along the way. Nobody in trading has a 100% win rate. I want you to understand that. Losing is a part of the trading game. You're not going to, even the best free throw shooters in NBA history didn't hit 100% of their free throws. All right. the best free throw shooter in NBA history still only hit like 92%, you know? So just understand that, like, regardless of what you're doing, you're never going to hit 100%. In baseball, if a slugger is hitting .35, that's only 35%, and that's considered great, right? So it just depends on how you're looking at it. All right. So your win percentage may be low, but if you have the right amount of reward connected to your risk, it doesn't matter if you only winning 25% of the time or 33% of the time. If you know how to play the market right and be able to capitalize on your great days. Okay. And so a conservative approach on a 1 to 2 risk to reward ratio is that's suitable for beginners and high frequency strategies. You know, it requires you only to win 34% of the time to be profitable. All right. It's easier to achieve, but it limits your profits potential per trade. Okay. A balanced approach. This is a more of what we're getting into when you start saying that 3-to-1 ratio. You know, when I first started, I had a $250 stop loss and a $750 profit. It's still in there. I just kind of raised my take profit up, but it's easier when you know I'm only risking 250, and if I win, I'm winning 750, and I'm walking away. And it only requires you to win 20% of the time to be profitable. Okay. So that's what you need to understand. The amount that you win is going to be mitigated by your losses. So you have to minimize your losses, maximize your wins, and understand the ratio of how you're trading. Okay. And aggressive approach is 1 to 5. So if they say for experienced traders with strong trend following systems, right? And very low win rates are acceptable, but it requires exceptional trade selection and patience. All right. And so a lot of times you can end up having a big move. Don't get too caught up on the win on the ratio necessarily, but understand that you need to win a more amount than you lose. And we're going to show you how to balance that, right? And so this is typically for depending on how you're trading, what you want your risk to reward to be. Okay. And so if you're scalping, which I do not recommend that for beginners, you're really looking for a 1-to-1 move. You're not trying to get just trying to get in and get out. If you day trading like we are, you're looking for a 1-to-2 move or a 1-to-3 move. Okay. And if you swing trading, same thing. You know, your swing trades may be a couple days or a week, but that's not what we're doing here. But I'm just giving you an idea because by the time you're done with this whole class, you're going to know about all of it and be able to make decisions on how you want to eventually continue your trading professional career. All right. And position trading, of course. And you know, position trading is like buying a whole thing like that. You may want to hold it for a while, you know, but understand where you're getting in at, where you're getting out at, and how much you may have to put up as risk in order to be able to get that reward. Okay. Uh Next thing we have here is your trade management. And so this is dynamic position adjustment. Your trade management begins the moment you enter a position. So your initial plan provides the framework, but the market conditions may require tactical adjustments to optimize your outcomes. Okay. And so that's the point. Your entry execution. You enter, you have your stop loss immediately placed and your position size verified. Confirm all orders are working correctly. And so basically what that's saying is soon as you hit buy or soon as you hit sell, you need to look. Make sure if you were only supposed to buy five, let's just say MESs, look and make sure that it's registered you for five MESs, not 10. Make sure it didn't double and triple click on you. And so that's what they mean, your position size. All right. Confirm all orders are working correctly. Make sure that it's in, that is you're in on your market order and not sitting in a limit order. Little things like that, you know. Your profit zone. Begin profit taking or trailing your stop implementation. And you move your stop to break even once you receive the 1-to-1 ratio. All right. And so for me, it's like if as soon as I get into a trade, based on market structure, based on how the market is moving, based on the last low, if once I get up into, let's just say, the $300 range, I'm hitting break even. When I hit up into the $400 range, I can move it up to 200, and you can kind of trail it up. But you got to also look at the levels of the market, understand where the markets are. You don't want to move your stop up into a bunch of traffic and then end up losing profits that you could have had. Sometimes you got to be a little bit more patient when moving your stop loss up. You need to let things clear out. You're going to learn how to do all of that. Okay. Early management, right? You want to monitor for quick profits or immediate invalidation. Consider scaling in if additional setup requirements are met. Okay. So if you see it moving in a good direction in your place, as you become a more seasoned trader, you may want to increase what you're putting on that trade to be able to maximize profits. So if you see that it's a clear breakout, instead of trading 5 MESs, you might want to throw one whole MES on there, just one whole ES, and maximize that day, as opposed to getting what the micros would give you. So it's about understanding things like that. Extended move. You trail your stop more aggressively. Consider scaling out additional portions as targets are hit. You're going to learn about that, how to move your stop loss up, how to be able to add positions if you want to. All right. And so management techniques, break even stops. You want to move your stop to the entry price plus commission once the trade shows one R or one risk reward ratio or a double up. All right. Scaling in, adding to winners only, never the losses. Additional entries must meet a certain criteria. So as I said, it may be a breakout. You may want to add more to that position. But if it's a losing position and it's turning around, why are you adding more? Like sometimes it doesn't seem like, oh, that's silly. Why would you add to a losing position? But sometimes that greed to get you, oh, it's gonna turn around. And if I put one more on there, no, all you're doing is just blowing your account faster. So it's little things that you got to understand along the way that will help you. And it's also things that will harm you if you don't get it immediately. Volatile adjustments. So you widen stops during high volatility sessions and you tighten during low volatility sessions. So if you're trading overnight, you may be able to have a smaller stop loss. You may be able to have a $75 or $100 stop loss. You're trading during the daytime, unless you get supreme prime position, you're probably going to need a $250 stop loss, $300 stop loss on one ES, or so understanding the dynamics of how the market moves will help guide you in how you're going to manage this. All right. And time-based exits, close positions that haven't moved favorably within the expected time. If you get into a trade and it seems like it's consolidating for 15 minutes or so and it's still around the same price, and you may only be up $100 at that point, it might be time for you to just go ahead, call it a wrap, and instead of sitting there through a specific consolidation that you now recognize, right? So you don't have to hold on to positions if it's not doing what you need it to do within a certain amount of time. All right. Overnight, you need to let your trades run longer. During the daytime, you probably want to be in and out quicker based on the volatility. But it's up to you to start figuring that out because there's no reason for you to be in a trade all day and it's a losing trade, or you're waiting on something to jump off that's not jumping off. That causes you to overtrade. That causes you to revenge trade, little things like that. So these are the details that help prevent you from doing silly things in the market, right? So some common management mistakes, because remember, you're not only a day trader here. I say that you're a professional risk reward analysis, right? Analyst, right? You come to analyze the market and determine the risk, the reward, and you make the decision based on your analysis, right? And so some common mistakes is moving your stop loss against you, to give your trade more room. If you get in and your trade don't got enough room already, you're probably not in the right position. That means you probably got in early or you probably got in too late. But either way, it's not a good idea to move your stop loss against you. If your stop loss is 250, leave it there. If your stop loss is 300, leave it there. Don't get in and say, all right, well, it's still in the way. I need to move it out another $300, $400. You need to, at that point, decide that you're gonna change your position size. Let me stop this share for a second.